Hello, everyone. My name is Manat Banassi, and I'm the first marshal of the class of 2022. Welcome to the very first Real World for Recent Grads event. Based on the beloved Senior Spring event series held over the past few years, Real World for Recent Grads will bring together recent college graduates across the 10 classes to learn from each other and discuss relevant real-world topics. This virtual event series will be hosted by class leaders in partnership with the Harvard Alumni Association. Today, we'll be discussing financial planning and planning for retirement. We hope that these are fun, informal, very casual, for us, by us type of events. We also hope that these can be conversational and not just a lecture at you. So if you're able to, please have your camera on, and we welcome your participation in the chat during the opening remarks, as well as feeling free to unmute and share any thoughts during the discussion portion at the very end. Note that we will be recording these sessions to share by email with recent grads and to post on alumni.harvard.edu. Before we kick off, I'm going to turn it over to John Prince at the Harvard Alumni Association to share some brief remarks.
Thank you, Minat, and thank you all for being here. Much appreciated. My name is John Prince. I'm a staff member at the Harvard Alumni Association. I'm also class of 2013, so I'm a member of the recent grad cohort. I graduated from Elliott House. And in my current role at the HA, I work with the youngest cohort of the college alumni community. So everything from engaging our current students with alumni, working with the senior class, and the recent graduates broadly, including through events like this. So if you haven't already, if you could please update your Zoom name to include your class year, in addition to what Manat shared earlier, that would be fantastic. So since this is the very first event in this series, I just wanted to share a little bit of background with everybody. And first of all, thank you to our three speakers tonight, Weishan, Edgar, and Elizabeth. We really appreciate it. We're looking forward to this. And so this is the chance to have more programming that brings together the entire recent grad cohort. In this case of this year, it's the classes of 2013 through 2022. And obviously every year the specific classes in this cohort will evolve, but we are still excited by the opportunity to bring this whole group together. And hopefully this inspires other connections formally or informally across these 10 years. So as Manat mentioned, this is building off of a recent tradition among senior classes. For some of the older classes in the cohort, this may be new to you, but for several years now, classes have been holding these events during senior spring to really teach opportunities to learn about life skills past college. And so the idea here is that we're now taking that from what would be most applicable to someone who's just about to graduate college to what are some of the topics that are actually relevant to those that are a year, 5 years, almost 10 years out. And many of you took that survey that we shared out in the fall, and that actually helped to inform what events we're starting with. So the top three from that survey were financial and retirement planning, which we're talking about tonight, a session on work-life balance, which we'll be talking about on April 24th. And then a third one for this spring that we'll hold is on volunteering and hobbies that we'll hold in June. And we're going to set a date on that soon, but not confirmed yet. So that's the plan for this spring. The hope is that over the next few years, we will continue this and we will tackle different topics. We'll probably go a few years before we repeat a topic, but hopefully over a few years, we can come up with some great content that can be shared. We are recording the sessions, as Manat mentioned, and hopefully that acts as a great resource to this cohort and community going forward. So I do want to thank all the volunteers that helped today happen, in addition to all of our speakers and Manat here today. This has really been a great effort by our HAA Recent Graduate Engagement Committee over the past 3 years to think about new programming for this cohort. And just for your reference, since you did get a few emails from this group, if you're wondering what that group actually is, that is the class committee leadership. So the first marshal, second marshal, secretary, and treasurer, and a few other members of the college classes up to 7 years out from graduation. And they work very closely with our office and my role on reviewing and designing processes to support recent grad volunteers, welcome new volunteers, and create cross-class programming like this. So I want to share that as a bit of background. In addition to this event, as a reminder, there are other opportunities for recent grads throughout the year, including several new ones. Welcome to Your City has been a tradition for about 10 years now. We relaunched a new version of the Harvard Yale Recent Grad Tailgate when the game finally returned to Harvard this past fall. That was very exciting. And there are also opportunities to be connecting with current students, such as Class Color Connect and class families. So as you receive invites to these throughout the year, we hope that you will engage. And before I wrap, I always like to open our sessions with a reminder of the mission of the HAA. So for those that still don't know, we are the official association of all of Harvard University alumni, not just the college, but all the graduate and professional schools as well. Currently more than 400,000 living alumni. And our mission is to maintain and enhance a highly engaged, vibrant community of alumni and friends worldwide. Within the HA, my team, which is the College Alumni Programs Office, we serve the college alumni population specifically, and we work with college volunteers to oversee and develop programming to preserve and maintain Harvard traditions and create new opportunities to connect you all to each other and to Harvard. So that's just the brief opening remarks I wanted to share. Beyond that, I did want to note that there is another recent grad event coming up next week. This is coordinated by the Harvard College Fund. It'll be a conversation with Harvard College Dean Rakesh Khurana. That is Tuesday, April 4th from 6 to 7. It will again be on Zoom. You should have received an invite to that, but I'm going to drop in the chat after this the link so that you can sign up if you haven't already. In addition to Dean Khurana, we have members of your community that are going to be facilitating this, including Berkeley Brown from the class of 2018 and Dennis Fedden from the class of 2017. So we're looking forward to that. And again, I'll drop that link into the chat in a moment so you can sign up. And so with that, I'll now turn it back over to Manat.
Thanks so much, John. Now we have Weishen Mead, class of 2013, who earned his degree in computer science. Since then, he's worked as a full stack web developer at tech companies at all stages, from Series A startups like DocSend to late stage pre-IPO businesses such as Lyft, as well as mid-size public companies like Dropbox and Athena Health. He's currently a staff software engineer at Dropbox and lives in San Francisco with his wife and 2 dogs. Weishen, over to you.
Thank you, Manat. And thank you, John, and all of you for joining. Hopefully everyone can hear me okay. I'm just going to say a few words before passing it off to the other speakers and talk at a really high level about sort of introductory topics. If some of you may already know some of this stuff, and we'll be able to dive in deeper with the other speakers as well as during the question and answer section. But from some of the early sort of pre-questions we saw, one of the major trends or sort of topics, right, about financial planning is retirement planning in particular, and thinking about how and understanding the very basics of what retirement accounts are. So I just want to go over very introductory level what retirement account options are, what those terms mean, and why they're called retirement accounts. So you may have heard things like 401k or IRA or Roth put in front of either of those words, so Roth 401k or Roth IRA thrown around. And essentially all of these are accounts set up to help fund your retirement, which really means 2 things. One, you get some advantages for putting money into them, primarily tax advantages, right? So the money grows tax-free, and depending on the type of account, comes out tax-free or goes in tax-free. And some disadvantages, which is primarily that you're not allowed to withdraw money without paying the tax that you would have owed or other penalties before retirement age, which is currently 67, if I remember right. But obviously that might also change, right? The retirement age has changed over time. At a very basic level, 401k is just an account administered by your employer, right? The company provides, whereas an IRA is one that you set up individually. And traditional IRAs and 401ks, the money that you put into them goes in without being taxed. It grows without being taxed, and when you take it out after retirement age, you pay taxes at that point. And then a Roth is doing sort of the reverse. The money goes in after you've paid taxes on it. It grows tax-free and it comes out tax-free. And we can talk a little bit more about the details of those things later on, or sort of how you might pick between them. The only other one thing that I wanted to mention about that is a 401k, when you leave an employer, you can actually keep your 401k. It's still administered by your employer. The money is still there. It's still yours. It doesn't disappear. However, if you want to, you can always roll it over and move it to another account, like an IRA that you set up yourself. Second thing I wanted to talk about is how to actually approach investing. This is relevant if you actually want to set up an IRA, for instance, but also if you wanted to set up any other sort of investment account or you wanted to purchase investments, put savings away. Very simple level, pick a provider, right? There's a number of major providers, Vanguard, Fidelity, Schwab. You can make accounts with all of them. You can pick one. We can talk a little bit later. I think the later speakers will talk a little bit about how you might select or make choices like this. But pick one, go to their website. It's pretty easy. They have an incentive to get your money right quickly, so they'll make it pretty easy for you. And once you go through that, you connect a bank account or some other funding type, and then you'll be able to put money into your, for instance, Vanguard brokerage and be able to start purchasing either stocks or bonds or mutual funds, et cetera, et cetera. Jumping topics really quickly to budgeting. One of the other things we heard a lot about at a very, very basic level, one thing you can apply is a thing called the 50-30-20 rule. It is roughly saying spend about 50% of your post-tax income on needs, 30% on wants, and 20% on savings or paying down debt. And it's basically one principle of that. Why is 20% a good number and 30% to spend on needs? Is that you want to also have enough money that you're able to use for things that make you happy. The easiest way to fail at budgeting is to, or fail at saving, is to make your savings goal so high that you feel like you don't have enough to actually enjoy your life today. And if you're doing that, then you'll constantly be fighting with yourself to actually put that money away and save it. So the idea there is to try and target a rate where you'll still have enough for yourself. Obviously, if you can save more, feel free to save more as long as you're happy with that. And then also on budgeting, if you need help or want a tool that can help you, there's a lot of other free services available. Mint is provided by Intuit. There's Personal Capital. There's YNAB, which stands for You Need a Budget, which is a great tool for specifically budgeting. And you can, again, try out all of them. They solve slightly different needs and are good at slightly different things. So you could use all three, you could use just one, but those are all things that can help with thinking about your budget. And the last thing I want to talk about that was touched in some of the pre-questions was thinking about paying off debt versus investing or saving money. And that's a very big topic, so I'm not going to go into it really in depth right now in these brief remarks, but the core thought there is to think about what the cost of the debt is to you versus the potential return on your investment. It's a very basic example. Credit card debt tends to charge a very high interest rate and is therefore very expensive to carry over. And so you will have a very high probability of not earning that much return on any money you save. But if you have a loan that you're paying 2% interest on in the current sort of very high interest rate environment that we've entered into, you might actually be able to earn more money on an investment somewhere else and sort of keep that rolling over and just paying your interest or paying your minimum payments. Okay, I think out of time, so I'll pass it off back to Manal.
Thank you so much, Wei-Shen. Next up is Edgar Carrero, class of 2019. Edgar is a private equity associate in Bain Capital's Double Impact Fund. Prior to joining Bain Capital in 2021, Edgar worked at Bank of America Merrill Lynch as an investment banking analyst in the consumer and retail coverage group. He earned his undergraduate degree in economics. Edgar, over to you.
Thanks so much, Manal. So the way I'll organize my remarks is I have a few topics I want to touch on, which I describe as probably like second order complexity after Wei-Shen's descriptions of the basics. And then I have a few questions that I want to hit on afterwards. So in terms of the topics, the first one I had in mind was an HSA, which stands for a health savings account. And HSAs are triple tax advantaged accounts, which make them the most tax advantaged accounts in the United States, meaning that you put in money pre-tax, it grows tax-free, and then you get to withdraw tax-free for any kind of medical expenses. And typically within more advanced personal finance communities, it's recommended that you actually not use your HSA, but rather contribute every year, invest it, and then save your receipts, and you're free to withdraw that whenever you please later on in the future. So it can serve as almost another Roth IRA, but even more tax advantaged. Then another interesting account is the 529 account, which many of you might be familiar with from kind of college or higher education expenses. And the way that works is some states give you state tax deduction, and you're able to, for example, in New York State, deduct $5,000 against your state taxes. In Massachusetts, you're able to deduct $1,000 against your state taxes, and you're able to withdraw that money, invest it, and then withdraw it tax-free for any kind of education expenses. Even if you've already gone through all of your education needs, you can pass it on to family and friends, children. So it's another good account, particularly if you live in a state with a state tax deduction. Then another topic I wanted to hit on was the concept of financial independence and what that means. So typically, financial independence is defined as not having to work anymore and your assets producing enough to cover your expenses. So that looks different for different people. but generally a rule of thumb is that 4% rule. So if you have $1 million of invested assets, you're able to withdraw $40,000 every year. And if you do that, in theory, you would never touch your principal. So in theory, you can retire at any age as long as you stick to the 4% rule. Some people get more conservative and withdraw less, depending on how long their time horizon is. And that takes me to my other topic that I wanted to hit on, which was FIRE, which stands for Financial Independence, Retire Early. Those are people that typically try to advance their strategy in terms of getting to that FI number. So early retirement can mean different things for different people, but typically in the US, we think of traditional retirement age around age 65, which is when you're able to start getting most of your Social Security benefits. Some people, if you're able to get to this number much earlier on and in theory create this kind of perpetual wealth machine, then you're able to retire at a much earlier age. And there's people that have retired in their 30s, late 20s, definitely 40s. So something to consider. And the big thing there is you want to grow the gap between your income and your expenses. So these kind of concepts are attainable on really any kind of salaries, but you have to create a gap between what your income is and what your expenses are. Then in terms of resources that have been helpful for me, some that come to mind are a book called The Simple Path to Wealth by J.L. Collins. Definitely recommend it. It's a great introduction to the concept of low-cost index funds and how to use that on your kind of financial independence journey. Then there's another podcast and book called Choose FI. I think the book is Choose FI, Your Blueprint to Financial Independence. And the podcast is just called Choose FI. So those are kind of the high-level thoughts I had. Now I'll kind of go through some questions that we received. So the first question I got was, if you work for an employer that offers a 401k, but no matching, is it still worth contributing? What if you already have a Roth IRA? So the way I think about that is, even if you don't get a match, there's still tax advantages to a 401k, which are typically being able to defer your taxes until later on. And you can even work through conversions within your 401ks that can definitely make it attractive. So is it more attractive than a Roth IRA if you don't get a match? No. So you should probably max your Roth IRA first, but before you put any money into a traditional taxable brokerage account, you definitely want to max out the 401k beforehand, as long as you're fine with the concept of locking up this money until you're later on in retirement. So it's less liquid, but there are advantages, even if you don't get a match. Another question I got was regarding investments beyond retirement. So some that come to mind are just opening your own brokerage account. So the way to think about it is, within your brokerage account, you're probably going to have very similar things to what you have within these retirement accounts. So all of these are just buckets where you put money and put investments, and you can have the same exact investments in different buckets. But if you've already maxed out all of your retirement accounts, still have more money to save, then you probably want to keep investing and just open a taxable brokerage account, which you can do at any of the providers Wei-Shen mentioned earlier on. And the concept there is, you're not going to have as many tax advantages. So you'll have to pay interest, taxes on your interest, taxes on your capital gains, but it's still preferable typically than to keeping just cash, which particularly in this inflationary environment, is worth less every single year. So that's kind of how I think about it. Within that universe of investments, I think through making sure you're picking low-cost index funds compared to higher cost index funds. All that means is there's an expense ratio, and that just means they're going to charge you that % of your assets under management every year. Vanguard was a pioneer in this area, and they have investments as low as 0.04%, which sounds really small. Some other places can charge you up to 1 or 2%, which also sounds small, but if you think of it as a quantum, you're talking about 25 times or 50 times the fees. So it's important to be in low-cost index funds, because if not, you have to outperform the market by that much just to get back to square one. And then, I think I still have one more minute. Then another concept people touched on was the backdoor Roth IRA and what that means. So basically, there's income limits on using a Roth IRA and traditional IRAs. You can find those online, but the concept is if you are phased out of any of these accounts, particularly at the higher level, the backdoor concept becomes possible, which all you do there is you make a traditional Roth retirement account without taking a deduction up front, then you immediately convert it. And once you convert it, you've effectively created a Roth IRA. And all you have to do is fill out one more form on TurboTax in order to be able to pull that off. And it's effectively a loophole that's been left in there for a long time, and it's been basically codified into law at this point. And then one last topic I got was the concept of life insurance versus traditional retirement options. I think of insurance as rarely a good investment. Think of it as you want to insure things that are catastrophic and you can't pay for otherwise. But I would separate your insurance from your retirement savings and investments generally, because the insurance company usually wins. And with that, I think I'm out of time.
Thank you so much, Edgar. Next up is Elizabeth DeWhaley, class of 2015. Elizabeth is a partner on an all-female, diverse, multi-generational team of financial advisors at Merrill. She has obtained a CFA designation as well as CFP, CSRIC, and CPFA certifications. As such, she's a strong proponent of financial planning and impact investing. Elizabeth, over to you.
Okay, I hope everyone can hear me well. Thank you, Manat, Waisha, and Edgar. I love the comments that you made already. Those were excellent. Very proud to hear that. Love hearing the sharing of really good information. You shared some really great tidbits here. But I want to get right to it since I only have 6 minutes. But afterwards, if you have any questions, please do feel free to add me on LinkedIn or reach out to me on LinkedIn. I'm pretty sure I'm the only Elizabeth DeWhaley that exists on LinkedIn, so you can find me very easily there. And for everything I say today, please keep in mind that everyone's situation is different. You know, we're giving general recommendations here or suggestions, but overall, everyone has their own, personal circumstances, and this might not apply to your specific situation. So keep that in mind. But we received some questions before the presentation, and many of you asked, how do I find a financial advisor? Is it actually worth it? Keep in mind that I am a financial advisor, so obviously I'm a little biased here. But I think it's worth it in specific circumstances. Depending on what your sort of net investable assets are, which means any assets that you have that are not with your existing employer. You can have access to certain different, you can think of them as different tiers of investment services. So at less than 250,000 in investable assets, there are a lot of self-directed or robo-advisors that you can leverage. Again, very similar to what Edgar was describing, which is little to no fee, where you can basically answer some kind of questionnaire and they can pair you with a robo-advisor that will tell you, okay, these are some suggestions for investments based off of the answers to the questions that you provided online. There are different companies that offer this service. Elevest is a really great company. Merrill Edge is also a great company. I'm a Merrill employee, so I have to say that. But there, most of the big firms offer this kind of robo-advisor service, and they tend to be very low cost. So if you're investing less than 250,000 in assets under management, it's a really great option, and it's available at very low cost. And then, these big brokerage firms tend to also have investor education that you can access. So Merrill Edge has a really great investor education website where you can try to get more information and learn more about investing. But when you get to close to 250 or more than 250 in assets under management, you have access to different tiers of financial managers or advisors. Sometimes they can be at a really great benefit to you. Folks were asking, which firm do I go with? Is it actually worth it? In my opinion, and again, this is all with the caveat, I'm a financial advisor, but in my opinion, all of the big firms are pretty similar and they offer very similar services. So really, as an individual, what makes sense is working with an advisor that you trust and finding the right person that you believe is actually listening to you and, looking to invest in a way that aligns with your goals and your preferences. They typically charge fees. Sometimes it's between 1% and 2% of the assets under management. A good advisor should be a fiduciary. And they should be able to effectively pay for themselves, if they're giving you good advice and they're diversifying your investments and they're giving you access to investment strategies that you wouldn't otherwise have access to, then that could really pay for itself over time. But not every advisor is the same. And depending on your personal situation, it might not really make sense for you. So, the important things to look for are advisors that are also financial planners so that they can align your goals with your investments. And typically the advisors that are fiduciaries are advisors that are credentialed CFP, CFA, that sort of thing. And that means that if they're a fiduciary, that means that they have to invest your assets in your best interests, essentially. So it's a really important thing to look for. And if you really want to work with an advisor, you should make sure that they're a fiduciary. So switching tracks a little bit, a lot of you had asked also about, how do I prioritize my investments? I want to buy a home, or I also want to save for retirement, or, I have all these different goals. How do I figure out how to organize this? And so my general recommendations are, first of all, determine your cash flow and your budget. Try to build out at least a good emergency savings, fully liquid in cash. Typically, the recommendation is having at least 3 to 6 months worth of expenses in an emergency savings account. You should try to also take advantage of any sort of employer advantaged investing, whether that's an employer matching or deferred interest. And then try to make sure that you set aside funds that are for specific short-term goals. And when I say short-term, I mean, within the next 5 years, you should try to invest for those goals. And then after that, think about making sure that you're maximizing your retirement accounts, Roth accounts if you're young. I know a lot of us on this call are very young, so please try to focus on Roth if you do have that option. You're not subject to the income limits if it's through a 401k, so through your employer. And then once you've done all of that, you can think about maximizing in your brokerage accounts. And generally try to align your investments with your investment goals. If you have a short-term goal, you might want to think about having shorter term investments, safer investments. If you have a longer term goal, you could potentially take more risk there and have a longer term type of investment. So generally try to avoid emotional investing and market timing and try to align your investments with your goals. And I think I've reached the amount of time that I have. So I'll pause there and, happy to take any other questions.
Thank you so much, Elizabeth. Thank you, Edgar. Thank you, Wei Shen. Now we'll open it up to a Q&A discussion and just sharing of resources. We welcome sharing any resources in the chat if you have links to them. And then please use the raise hand function in Zoom and we'll call on you. Beforehand, though, a few alumni have reached out to us in advance, so we'll start with them. To begin, we'll turn it over to Carolina and Natalia, who will share a little bit about the work they're doing in this space with their company, Dinery. Carolina and Natalia, feel free to unmute.
Great. Thank you so much. I really appreciate it. What an awesome forum to have. So hi, everyone. As mentioned, my name is Carolina Weber. I was class of 2013. And then my co-founder, Natalia, is on the call as well. I'll let her intro herself.
Thanks, Carolina, and thanks everyone. This has just been so great to be a part of this tonight and to be like a part of this conversation. So as Carolina said, my name is Natalia. I was class of 2014. So while Caroline and I both went to Harvard, we actually didn't connect until we recently both did our MBAs at the Wharton School. We connected actually over our passion for bringing financial literacy to young people, immigrants, and first-generation students. So that's why we created our company recently. It's called Dyneri, so it's spelled D-Y-N-E-R-I. And we're really excited to be starting that really recently.
Yeah. So as Natalia said, we met in the MBA program and we're bringing our MBA finance degree and professional experience in the financial sector. And what Dyneri does is it breaks down, as you've heard, oftentimes topics that are highly complicated in the financial space and makes them a lot more digestible to understand. And so in the long run, we also want to be able to provide recommendations to free resources and reputable products. So yeah, please check us out. I wanted to mention, I'll drop it in the chat as well, that we are mostly right now on TikTok and YouTube under the handle The Real Dyneri. So would appreciate the follows, subscriptions, all of that good stuff. But yeah, we did have a question to kind of kick off the Q&A session. And I think this is something we think a lot about, particularly dealing with young grads that maybe may not have the cash flow for whatever reason. We talk to a lot of people that, they are their parents' retirement plan. So in unique situations where, again, you may not be able to set aside as much money, but what's kind of the number one highest leverage thing to do that you all would recommend, particularly, again, if you can't set aside as much money and you're starting out earlier in your career or whatever situation is on hand. So I wanted to toss that question out.
I can start. If your employer has a matching program, it's kind of like having 100% return. So that's a pretty big leverage thing to do. It's sort of like free money that's sitting on the table. So I would suggest, if you want to maximize your overall investment potential, take advantage of, employer options that give you free money, essentially. Any other responses to that?
I agree. I think after that, I'd do my HSA and then my Roth IRA.
I don't have much to add there. I think, yeah, taking advantage of the tax advantaged accounts you have access to. Right. Anything that multiplies the value of your saving there.
Awesome. Thanks, everyone. So right before some other questions, we also have Kanishk on the phone who want to speak briefly. So feel free to hop in.
Hey guys, can you hear and see me? Fine?
Yes.
Yeah, thanks for the great information. As a very recent grad, I graduated in 20. I might add that I think the budget is really the most important tool you can have, because I think it paints a high level picture of where your money is going. And I think, as it was said earlier, if you set a very, very aggressive target, you will find yourself wrestling with it. I did that early on. A couple of great tools were mentioned here. I'm just going to elaborate real brief on a couple of them. Mint is a good tool. Not a huge fan of Mint because they do use the personal information you give for marketing purposes. Simplify is another tool out there that you pay for. I think it's $50 a year, but they don't do that. It's a very modern UI. You can connect 10 different accounts from 10 different banks or brokerages, and it'll be the central source of information for everything. So you can get a high level view of where your money is going. You need a budget is also great. It does take a little bit more effort to set up though, because it's $0 budgeting, and there you're effectively committing to managing every last dollar of your budget, as opposed to creating a higher level view of where you want things to go. So I think once you get started with that, you'll automatically see where your money is going on a day-to-day, week-to-week basis, and that'll give you an idea of where you want your money to go and how you might want to shift your spending habits and patterns to align more with your long-term goals. Apart from that, 401k IRA, really take advantage of that. It might be worth understanding the concept of tax advantages and what a double tax advantaged account versus a triple tax advantaged account is. I think that's really at the core of all of these different saving accounts. And if you understand that, you'll automatically understand how to manipulate them or really optimize them to be beneficial for yourself. Yeah, sorry, I think I really went a little bit fast there, but only had a couple of minutes. Yeah, if you have any questions, happy to take them as well.
Awesome. Thank you so much. So I think now for the remainder of our session, we have about another 11 minutes or so. If anybody wants to ask any other questions, feel free to drop it in the chat if you can't speak, or if you want to just raise your hand in Zoom, we can then call on you and you can unmute. Also, I know many of you have been sharing really great resources in the chat as well, so feel free to continue doing that. There is a question, what are people's thoughts on investing in the stock market in today's climate versus something like a CD given interest rates? And maybe someone could also explain what a CD is for those that don't currently know.
Yeah, I can answer that. So CDs are certificates of deposit, and typically a bank issues that. The thing to keep in mind there is that they're insured. If they have FDIC insurance, they're insured up to $250,000 per CD. So the key thing is to make sure if you're getting a CD that it is FDIC insured. Right now, the rates for CDs for a 6-month or 1 year are hovering at around 5%. So it's a really great option if you're looking for something that's relatively low risk, almost no risk, because it's insured by the federal government if it's FDIC insured. So I think it's an amazing option at this moment in time. CD rates are not always going to be at 5% over the long term. If you really want to grow your wealth, typically the stock market is the way to go. But if you want a very low risk investment, for the next 6 months to a year, a CD is a really great option.
Yeah,
Something.
Go ahead.
Sorry, I was going to say something I might add is treasury bills as well. So depending on how volatile the market is, these bills can also offer some really attractive rates. And I think last year the 6-month bill was offering almost double-digit rates of return, and a T-bill is about as safe as your investment gets. I mean, investments guaranteed by FDIC are essentially on par with T-bills because the government is backing them. But T-bills could also be something worth looking into.
The only thing I was going to add on that is there's a saying that's not always true, but it's generally true, which is that time in the market beats timing in the market. And so when thinking about your long-term investing plans, and I think Elizabeth mentioned this about not being emotional with your investments, it's really easy to look at how the market is doing today, how it did 3 months ago, and having anxiety about what might happen in the future, particularly when you're thinking about long-term investments, 10 years, 30 years, 50 years. The short-term fluctuations in the market will smooth out and won't matter as much. And it's mostly about setting up a plan that you can stick to over time. So for instance, if you just say, I'm going to invest $100 every month into the market, and I'm going to buy the same index fund every month with that $100, $1,000, whatever the amount is, and stick to that, you will actually probably wind up coming out pretty well in the long run. Versus if you worry and you try to take your money out of the market when it's down and try to move it to something else. Essentially, when the market is down, it's actually a good time to be buying into the market because in general, the market tends to go up over time. Sometimes that's not true, but the odds are in your favor there.
I agree completely. And I think at our age, our time horizon for most of us is basically 40 years plus. So I'd recommend being 100% equities if you have the stomach for it. What that means is that you can't sell when you see your account go down 50%. As long as you're fine with that, you should probably be 100% equities.
And I think the simple path to wealth, which has been referred here, actually has some really good examples of stock crashes and how soon the market recovers from them. And you really just have to stomach it out because in the longer run, the market will always go up. Growth is a continuous process. And if you can just weather out the rougher periods, you will do really well. And if you really want to drive it home even more, you can try and look at the returns asset managers have offered, and you'll see that most of them actually do not beat just putting money in a good index fund. And that should tell you that timing the market is, virtually impossible for someone like us. It takes a lot of research, a lot of tools. It's a big investment. If you're not doing that, just stick to an index fund.
We have some activity in the chat, but Seats, I don't know if you want to ask the question out loud for those that aren't following
Yeah.
there.
Hey everyone, I'm Seat to Go For It, class of 2015. Thanks for all the great advice and awesome to see so many friends on the call. I just wanted to ask if you had any advice on student loans, managing student loan repayments. I had a question about the sort of federal payment pause and whether it makes sense to continue making payments now or to pause on that and use that money for something else, and then also refinancing student loans. Is this a good environment to try doing that, or is it better to wait?
I can answer that one. So it's sort of all about interest rates. If the rate that you're getting is effectively zero because you can defer making payments on your loan and the interest is not accruing, then, you know, if you can get 5% in a CD, that beats 0%. So it's all about comparing the interest rate that you're getting, you know, on a relative basis. So if you can get 0% on deferring and you can invest that, then you can get more in the meantime. You know, if your interest rate is accruing currently and you can defer, but you're still accumulating, then that's not really to your advantage. So it's all about the relative, you know, interest that you can get when you're comparing against different investment options. Any other questions or thoughts?
On the question, I do see there's one other question. I think thoughts on best vehicles for transferring wealth intergenerationally. I believe 529 excess can become retirement savings for a child up to 10K based on recent changes, but curious what other good options are. And Edgar already answered some of them in the chat, if you want to say that.
Yeah, happy to. So I think Roth IRAs are really powerful, and most of that has to do with the fact that you get a tax basis step up, or the people that inherit it do. Or so I think if I'm right, then I think that basically means that they're not gonna, if you bought it for 100K, it's now worth 2 million. I think they inherited it like a $2 million tax basis. There's also no minimum required distributions, which 401ks do have, and those force you to start drawing down once you hit a certain age later in retirement. So those can be suboptimal depending on what your tax situation is at that point in time.
So that's mostly right. It's just that for a Roth IRA, it's actually not taxable at all. So there's no step up that happens. So for the step up, it applies if you have like a taxable account. That's when, you know, if you're inheriting assets, then the assets step up once there's an inheritance. But for Roth, actually, there's no step up that happens because there's no taxable event there, which is really great. So 100% correct. You know, the Roth is the best thing. And then once you have your Roth maxed out, taxable accounts are actually a really great option, which is not intuitive. A retirement account, if it's a traditional retirement instead of a Roth, there's no step up that happens. So then your inheritors have to pay at their income tax level. So if you have a Roth, there's no taxation. If it's a traditional retirement account, that there is taxation at income. And then if it's a taxable brokerage account, then they are eligible for the step up upon passing, and then your inheritors don't have to pay very much in taxes because they're eligible for the step up. If your estate is at a really high level, you should be working with an estate attorney, because estate taxes can get very crazy if you are, inheriting more than, let's say, $11 million or whatever the federal exemption is at the time. So if you have a very large estate, you should be working with an estate attorney to get assets out of your estate and establish trusts and so on and so forth. But the Roth is the very easy, straightforward, most practical way to do that starting out.
And then one other very direct form of wealth transfer intergenerationally is, like Elizabeth mentioned, the estate tax that you might hit. Also a gift tax exemption amount annually, which I believe is $15,000 per person. So that would mean each of your parents, for instance, or each parent could give $15,000 separately, so $30,000 to a person. If you have a spouse, they count as a separate person. So you can technically transfer $60,000 without needing to report it as a transfer per year. Which if you are, for instance, it will not matter for anybody who's not approaching that $11 million state tax limit sort of at the end of the transfer, but could allow you to transfer money if you're either near the bubble or before hitting that point, without having to pay taxes on that amount.
Yeah, that's a great point, and it's per person. So it's, you know, you and your spouse and every child and their spouse and so on and so forth.
That was great. Thank you all. I think Manat, I'll turn it back over to you now to close this out.
Awesome. Thank you so much, John. Thank you, Wei Shen, Edgar, Elizabeth, and everyone else who's contributed to the conversation and joined us today. It was so good to see you all. Thank you for helping us start a new Harvard tradition. Our second real world event for recent grads, like John mentioned, will be on Monday, April 24th at 8 p.m. And we'll be discussing work and life balance with Tirza Hill, class of 2020, sorry, and Athena Bow, class of 2015. Email invitations will follow. And if you'd like to join as a speaker, please be in touch with John Prince. Thank you all again, and we'll see you at the next one.
Thank you all.
Thank you.
Well.